Welcome to Petros Family Wealth. Today we're going to talk about 4 different types of downside protection that you can add to your structured note portfolio. The 4 types of downside protection that we're going to talk through today is 1, principal protected note, 2, a barrier protection, 3, a buffered downside protection, and then the 4th is going to be a geared buffered downside, which is a little bit trickier, so we're going to spend some time on it. But before we dive into some of the hypotheticals, I just want to share that none of the hypotheticals we share today are recommendations for you and your family or past recommendations for clients. This is purely meant to arm you, educate you, and help you become a better investor should you decide to incorporate structured notes into your portfolio. The first one we're going to talk about today is a principal protected note. And it's just exactly what it sounds like, that the principal is protected even if the underlying investment is negative and substantially negative. But there's 2 different levels. So the first one, which is what we found is generally more common, is principal protected based on the full faith and credit of the issuer. Meaning that if we were to lend money to a bank in the form of a structured note and the underlying investment, whether it's positive or negative, if the bank fails and goes in through bankruptcy, you may lose all of your principal. But if the bank continues paying their debt similar to a regular bond and the underlier is significantly negative, well then the principal was protected and you didn't lose any of your investment there. The other level of principal protection note is you can actually add FDIC insurance, similar to a certificate of deposit that you might get at a bank. But generally those are higher cost because the bank adds or pays for that insurance. So that generally does limit folks' upside or income potential because of that extra level of protection, where even if the bank fails, the Federal Deposit Insurance Corporation would back that investment there. So let's go ahead and give an example of a principal protected note without FDIC insurance. In this example, this one is based off of the S&P 500 for a term of 5 years. And let's say we invest $1,000 into this structured note. If the stock market is up 50%, well, the client will get 1-for-1 upside or full participation on the upside. But generally you see on the principal protected notes some sort of maximum return or capped return in order to help pay for that level of principal protection. If we put $1,000 in and 5 years from now the market's up 100%, well then we're going to be capped at that 75% return. However, one of the main focuses on this type of downside protection is in a severe downturn. Let's say the stock market 5 years from now is down 40% or 30%. So long as, again, the bank that we're utilizing continues paying their debts, then the client would receive all of their principal back and didn't lose anything. So that's an example of a principal protected note. The second one we want to cover is what's called a barrier protection. And this one sometimes we call as a cliff protection or a soft protection. And generally we see these that are tied to income or yield-oriented notes that can be generally on the more conservative side of things. And what I'm going to show you is a situation where the barrier protection worked and another situation where the barrier may not have worked as well. So in this hypothetical, this is based off of a Dow Jones small cap and the S&P 500. Term of 5 years, and generally they're based off of the lesser of, so the worst performer of the 3. And again, they're generally tied to a certain level of coupon payments or call premiums at certain times. But really wanted to focus mainly on the downside protection and the aspects here, where let's say over the course of that 5 years, the worst performer is down 15%. Well, then the client would receive their full principal back. However, if the underlying investment at the end of that term is down more than that barrier, and so in this example it's a 30% barrier, well then the client would be down 31% on their principal. Now they may have got some coupons along the way that enhances that return, where it may not be a loss. However, the principal would be down 1-for-1. And so that's why we call it a cliff protection or soft protection. The third type of protection I want to talk through is what's called a hard buffer. And this one's a little bit easier, simpler to understand. Basically, whatever a hard buffer is, it eats that percentage loss at the end of the term. So for example, let's say it's a 5-year note with a 10% downside hard buffer. At the end of that 5 years, let's say the underlying investments is down, let's say negative 25%. Let's say it's a rougher time period there. Then the client would be down 15 instead of the 25% that they would have in the underlying investment. So it basically eats that first whatever percent loss that you see. Generally, we see these hard buffers more associated with growth-oriented notes, where you are trying to have a level of participation or upside participation on a certain index or indice. And then this would be an added protection where if the underlying investment is negative, well, it at least dampens some of that downturn for you. Now, the last one I want to touch on is the fourth one is a geared buffered downside. So this one will definitely need to have an illustration for you that I'll have. And it's very similar to a hard buffer. Protects 1-for-1 down to a certain level. So let's say 15% geared protection. At the end of the term, the investment term, let's say the underlying investment's down 15, well, then the client gets all their money back. However, once you go breach beyond that geared protection, it actually increases the loss more than 1-for-1. So let's take a look at a chart as an example. So in a regular hard buffer downside, we have a 10% hard buffer. At the end of, let's say, a 5-year period, the underlying investment's down 30%. Well, then the client or the investor would be down 20. However, if you had a 15% geared buffer, now you might have some more protection. You actually have more protection there for that extra 5%, but then it starts to ramp up as far as the downside. So why would we do a geared buffer? A geared buffer generally costs less as far as that level of protection than a hard buffer. So if particularly for those growth-oriented structured products that somebody might invest in, it might actually be cheaper to have a 15% geared buffer than it would be to have a 10% hard buffer because you're amplifying some of that downside. And so what that allows you to do is maybe have a little bit more participation on the up should the underlying investment go up. And so a lot of times you just got to weigh that level of complexity with that potential enhanced upside. But one thing I do want to point out here in these examples, with that complexity, now you're hedging or you're protecting for more normal downside over the end of a 3 or 5 year period. In the 10% hard buffer, underlying's down 15, your down's 5. But in a gear buffer, you get all your money back. But the break-even point is not until a negative 40% return. And so particularly if it's a longer term, 5-year type of growth product, then it might make sense to have the geared buffer, which protects for more scenarios generally, but then helps enhance the upside for if the market over that 5-year period is rather fruitful. So I hope you learned a few ideas as far as what types of downside protection that you can incorporate for your structured notes. And if you did find it helpful, please go ahead and like, subscribe, and hit that notification button. Thank you so much.